Hello, everyone, and welcome to today's roundtable event hosted by the Southwest Regional Manufacturing Association, or the SRMA. I'm Jeff Poirier. I'm going to be moderating today's event. I'm the board president of the SRMA. The idea of the SRMA here is to promote idea exchange among businesses and manufacturing, provide resources and contacts for those businesses, and fill some knowledge gaps and connect some people within the industry here in Southwest Florida. So today's roundtable is going to focus on financial risk management. Mitigating financial risk was one of the main pillars of a successful operation in a business. So today's topic is relatively broad. Financial risk management can mean a lot of different things. So what we're going to do is we're going to narrow it down a little bit. We'll talk about cash flow management, mitigating risks, maybe from an insurance basis, tax laws, and then PPP and maybe some credit lines. So while some of these, may seem more like risk management, they're more tacked towards the operations side. It directly leads to a better profit margin, being more efficient. So they are directly related. Today we have 4 different expert panelists for our roundtable. What I'll do is I'll be asking questions to those panelists and going back and forth, and we'll kind of have an open discussion. So first we have Donald Trummer. He's a CPA with HBK Tax Advisory Group. Following, we have Scott Gregory, who's the Vice President and Business Insurance Agent with McGriff Insurance. We have Joseph Janoska, Senior Vice President and Senior Relationship Manager of Commercial Banking for Bank of America. And then we have Neil Schneider, who's a CPA, CBA, MBA with Florida SBDC at FGCU. So in these roundtable events, we like to spur discussion, debate, and bring up topics that most individuals and businesses just might not have time to address during their busy work week. So I want to bring it out in the open, spar some thought. We like to bring in experts and specialists within the region so you get some new topics and avenues of research for your business, but also you get an idea of what we have in this community and what we have to offer for both the manufacturing sector really and just industry in general. So while Southwest Florida may be not known for its manufacturing, it still has a unique mix of professionals, and we have some recently retired individuals that moved down here for the weather that really still have a lot to offer and still want to be integrated in part of the manufacturing environment down here. So if you don't get a direct answer to maybe a question today or just spur something else, provide some questions. So SRMA, part of our goal is to determine what the manufacturing association and just the economy down here needs. So the more questions and the more feedback we get from manufacturers and affiliates, the better we can craft this type of a presentation and our offerings to the community down here. So you can always send us an email as well too. So info@srma.net. If you have any additional questions for us or the panelists following one of these presentations, you can shoot that to us. Visit our website, www.srma.net, just to get an idea of what we are, what we provide. And at this time, I'm going to introduce the sponsors. We have 2 sponsors today's event. Geis Construction is the first sponsor, so thank you very much. We have KP here on the Zoom call. KP is the Vice President of the Florida branch for Geis Construction. And we thank you again for sponsoring this event. KP, can you give us a brief overview of Geis Construction, your offerings, and your community effort here?
Sure, I appreciate it. Thank you for having us today. So real quick, I know I'm limited in time. So Geis was founded in 1967. It's family owned and operated. Geis is comprised of 6 unique divisions. We have a development division, architectural division that consists of over 32 architects, a construction division. Our construction division has locations in Florida, 2 in Ohio, New Jersey, Los Angeles. We're licensed in 44 states. We travel. We've done business in some, for example, Philadelphia, Pennsylvania, Massachusetts, Georgia, Alabama, Arkansas, Utah, and many other states. Our, past related clients, manufacturing, we've done over 200 plants. Our area of expertise, some of which are aerospace, plastics, manufacturing facilities, tool and die. I won't go into the details since we don't have much time. We've done, some of our clients have been Amazon, Best Buy, IBM, DuPont, Mickey Thompson, Thermo Fisher, and Bendix. We have a property management division that manages over 52 facilities, over 7 million square feet. We also have an interiors division for space planning, interior design, procurement services. We're also supply furniture. We're a Technion licensed dealer. We also have a financial arm of the company. We employ over 350 team members. Our annual volume is a little over 350 million. We've completed over 13,000 acres of industrial. The first project in Florida for Geis was actually in the 70s, right here at airports, Lee County Airport Woods. And then in addition to our manufacturing portfolio, our team here in Florida, myself, Todd, and some of our other team members, our expertise has been about $2.6 billion in construction in Southwest Florida alone. Some of you might recognize Craft Construction. That was my family's company that we sold in 2007. I served at Craft for 23 years. We completed over $6.8 billion worth of construction in Florida. We sold it to Manhattan and I continued to serve Manhattan for 13 years after the fact. Todd, who's here with me also, we've worked together for well over 20 years. Some of our past projects were, notable ones that you recognize: Twins, Red Sox, Seminole Casino, Arthrex. We've done the downtown streetscape, the 52 blocks, Marina Towers in Cape Coral, 51 condo towers, such as High Point and the Colony. Those were over $3 billion worth of condos. Government buildings from Lee County all the way to Naples. Collier schools, we've done probably 60% of the schools locally. Healthcare, RSW. Before joining Geis, we did over $350 million worth of work at RSW. Roads, bridges. So as you can see, we have a tremendous diverse portfolio, but the company is an award-winning design, build, single source project delivery organization. And the projects are, they range from small to over 1 million square feet, and we're capable of building projects in excess of $100 million. And we really appreciate you allowing us to join you guys today. We're excited.
No, thank you, KP. I did take a look at your website. Pretty impressive portfolio. If anyone has a chance, you can just Google search Geis Construction. You can see all the stuff they've built. I'm sure you're enjoying the boom we have going on down here as well too. It's pretty good for everyone. All right, thank you again, guys. Appreciate your sponsorship. Next, we have McGriff Insurance. So our panelist, Scott Gregory, they actually sponsored the event, and he's providing his time as a panelist today. So thank you, Scott. If you want to go ahead and tell us about McGriff Insurance.
Well, good morning. Thank you. Yeah, certainly. My name's Scott Gregory with McGriff Insurance here locally. McGriff Insurance is a wholly owned subsidiary, the insurance subsidiary of Truist Bank. And Truist Bank is the most recent merger of the BB&T Bank and SunTrust. And you may see some of the signs of things being changed here in Southwest Florida, one of the largest financial services mergers of last year. So we're the wholly owned insurance subsidiary. We're the 6th largest insurance broker in the country. My office is located here in Bell Tower Mall. We have offices throughout the country, and we're currently expanding. So we're a very large insurance operation. Really what we do here locally is I'm on the commercial side. I've been, if you remember back, Oswald Trippin Company, which we sold to BB&T Insurance, and BB&T Insurance has now turned into McGriff Insurance. McGriff is our new branded name nationally about a year and a half ago. In the past, we had been under many different names throughout the country for various licensing reasons and things like that. We recently just rebranded to McGriff. What we do on a global basis, we handle accounts from commercial lines, personal lines, and the employee benefits here locally for many large businesses, nonprofits, and a very substantial condominium homeowners book of business, since that's really what we have a lot here over the years. On a national basis, we deal with Fortune 500 companies down to local companies that may only have a few million in revenues. We can actually handle from captive insurance all the way down to a risk management program for a local business. So the resources that we bring on locally really come from a national perspective, where we have an analytics department, we have a captive department, we have claims advocates and people that can assist on large claims. We have national products and national brokers that we have an opportunity to get in front of. So what we do and what I do here locally is we bring the national resources here locally, depending on what a business needs. So what we do is really customized to what a business needs. If they need analytics, we have that. If they need claims assistance, we have that. If they need claims advocacy, we have that. Workers' compensation mod verifications, we have that. So when we sit with a client and we sit to see what they need and what their insurance needs really are, we bring those resources that are available after meeting with the client a few times to kind of see what they need. So there's really no size business that we don't handle or we can't handle. It's really up to, the relationship and what a client needs. So, we've been here for 25 years. We'll be here for a much longer time as this area grows, and hopefully our manufacturing base grows as well. We have some national manufacturing accounts to a significant amount of the manufacturing up in South Carolina, which may seem odd, but it's a very much of a growing area for manufacturing. Has been really great for us. So that's a little bit about us, and I really appreciate the opportunity. I want to thank everyone for having us. We're certainly excited to be a sponsor. And with that, I'll turn it back.
Thank you, Scott. And again, thank you, KP. We appreciate both of you guys sponsoring the event. Scott, thanks for being a panelist today. So that brings us basically to the roundtable portion of this event. Like I said, if you have any questions or you want to contact us, you can visit our website, www.srma.net, or email us at info@srma.net. So each event is recorded, so this will go on our website so someone can watch this at a later time. If any audience member has a question during this event, you can actually ask a question through the chat feature on Zoom. Periodically, I'll be checking that chat feature and integrating that into some of the questions that I have. Again, follow up at any time, contact anyone that's on the board if you have questions, and if you want to get involved, just reach out. So thank you again, everyone, and let's begin. So I don't pretend to be, an expert in both cash flow management, accounting side, banking, PPP loans, and credit. So some of my questions may be directed more from someone that's coming from the business side. I may ask them kind of out of order. So I'm not trying to stump you guys. If you want to pass, you can pass. If someone wants to answer a question and throw themselves into the mix, just kind of raise your hand or flag me down, and I'll ask that for you as well too. So I'm going to start off by going through the panelists. I'm just going to ask, how do you define risk? And Scott, we'll start with you. What do you define as risk for a business, specifically manufacturing, I would say at this point?
Oh, sure. For manufacturing, yeah, I'll bring it down a little bit. I mean, risk to us is many different things. If you take a look at traditionally, for manufacturer, traditionally, if you're a smaller manufacturer here in Southwest Florida, when you look at risk, you're thinking about insurable risks. You're thinking I can buy an insurance policy for my workers' compensation, take care of my employees. I can buy a property policy for my property and my business income. I can get general liability for my products, what we're putting out there. I can get directors and officers liability for my directors, officers, the management of the organization, and or an umbrella policy for additional liability limits. Most small businesses, or I would say smaller to mid-sized businesses, when we think about risk, we think about the insurable risks. But I would say from a manufacturing perspective, and to make it a little bit bigger and to round this out, and really which would be more of a best practice, is to look at risk on a much more of a global scale. When we look at risk from a business, there's really 4 different buckets. First, we have our strategic risks, which are really becoming more important than the insurable risks for a business today. Things like blockchain management. Where are you getting your materials? What is your source of those materials? Now we see with the whole COVID, you see all the slowdowns in getting materials and things, and these are risks that we probably have never traditionally thought about. But we call them strategic risk, and those strategic risks can be reputation in your brand. It can be your business perpetuation. It can be leadership development, and now it can even be what's very important, information technology and cyber. The second bucket we have are operational risks. The operations, the day-to-day, supply chain, business continuity. Do we have product recall, regulatory compliance, all of the things that are coming from an operational type of perspective, to include data breach. Data breach now as manufacturer, everything, and even in our own personal lives, most of what we have has a computer linked in there somewhere. And we don't know who's in that computer at any given time, or what we bought or how it's being accessed. And we'll talk about that later.
Okay.
Next, more important to this is really a financial risk. Financial risk, and I'll leave it up to some of the other folks, your tax minimization, cash management, accounts receivable, and your deductibles and your retentions. And then finally, the 4th bucket is your hazard risk, and that's your insurable type risks. So when you look at risk, if you really want to look at it from a global perspective and use as a best practice. More and more companies are looking at the larger, bigger picture, not just the policies that we buy, but what is the environment I work in? What are my operational risks? What are the regulatory issues coming down the road? So when you take a look at risk overall, it's a much larger discussion that we would have, and that we would expect the C-suite type people to be thinking about, not just 6 months down the road, a year down the road. Where are we going to be in 3 years? Where are we going to be in 5 years? This coronavirus, if it's taught us one thing, that we really need to understand our vulnerabilities, which you could call risk, and we really need to have a plan in place, or at least some thought about what we're going to do, when these unknown, unanticipated type of risks all of a sudden put us out of business, put our suppliers out of business, affect our customers, and affect our day-to-day operations. So I think, yeah. So I just wanted the 4 baskets: strategic risk, operational risk, financial risk, and then the hazards.
Thank you, Scott. Donald, same question, basically. From the CPA side, what are you looking at as big risks if you're looking at someone's P&L or something along those lines?
Yeah, so from the financial reporting side, most importantly, we're making sure that all our clients are following the generally accepted accounting principles. We're correctly reporting revenues, taking deductions where we can, capitalizing what needs to capitalize, just kind of most importantly, making sure we're following all these regulations so we can appropriately report income and losses. And then from the tax perspective, kind of like Scott said, we want to make sure we're minimizing our tax liabilities the best we can. So making sure that if there's benefits or deductions we can take that or accelerate for tax purposes, we're doing so. And then in addition to that, making sure we're looking out for tax credits that may help kind of refund us some of these tax payments we're making already.
Okay, thanks, Donald. Neil, same question, but you're with the Small Business Development Center, or the SBDC. What do you see, I guess, especially along the lines of small businesses in terms of risk? I know they don't have the resources maybe to, dig into these things as much as a larger firm.
Well, first of all, I'd like to concur with the other 2 comments. One of the most important questions that I get from small businesses is they think that because they form an LLC that they're protected from any liability. The first thing I tell people is that the only way to protect yourself from from a risk of lawsuits is to buy liability insurance. The LLC really doesn't protect a small business person from a liability standpoint, because the courts have told us many, many times that everybody is responsible for their own wrongdoing. So the reality is that if you want to be really protected, then you need to contact your insurance agent and make sure that you buy professional liability insurance within the industry that you're in. From the standpoint of taxes, from the standpoint of staying in business, we see that one of the major problems that we have is cash management. In the manufacturing industry, we have what we call a long business cycle. That long business cycle means from the time that we pay for our raw materials, our WIP, work in process, our final goods that go that we produce, how long do they sit in our inventory? How long do they sit in our shop? And then after that happens, we sell it, and then how long is that AR going to sit there until we get our cash? So we call this the cash conversion cycle. We have to manage that. The shorter that we can make that cycle, the more cash that we're going to be able to put in our pocket, but more important, the more cash that we're going to have to grow our business. Our customers like to use us as a bank, and therefore they like to hold our money as long as they can. We like to use our vendors' money as long as we can. So we like to use our vendors as a banker at no interest. But we have to make sure that we're not extending our privilege with our vendors, because the reality is if we start doing that, then we may lose discounts, and we may lose the privilege of having 30 days, the same as cash. The other thing that I see in the small business environment is cost allocation. Small businesses don't have the resources to be able to understand what the real cost of the product is that they're producing. They forget to add in overhead costs. They forget to add in indirect costs. They forget to add in the real payroll cost of what it costs them to pay their employees. They take the hourly rate and they don't really include the benefits, the workers' compensation, the reemployment costs the state of Florida provides, requires you to pay. We calculate this with our clients to be anywhere from 20 to 25% of the payroll of the actual wages. Now, if you don't include that, you're really not making the money off the product that you think you're making. Same thing with raw materials. When you bring in the raw materials, you have indirect costs in the raw materials in your manufacturing plant. When you bring in that WIP, the work in process in the manufacturing environment, what you're doing is you're bringing in costs that you're not even thinking of. The costs that you're not thinking of is the screws, the glue, and all those indirect costs that it's costing you to produce that product. So I kind of like to focus on what's cash management, because without cash, you're out of business. And the third thing that I like to focus on, and just tell me if I'm talking too long, the third thing that I like to focus on is growth. Most small businesses think that they can grow with the same resources that they had before they started to grow. Well, if you're going to grow at 20%, you better look at your balance sheet. And most small businesses don't even know what a balance sheet looks like. They don't even understand why profit doesn't equal cash. They don't understand that the fact is that they're going to need more assets. They're going to need more human resources. So how do we obtain those? Well, there's only two ways to obtain those resources. And that is through the retained earnings on the balance sheet that you have kept instead of paying yourself. Most small businesses today become S corporations, so they can take all the distributions that they want. The second way that they can do it is they get short-term or long-term loans. Or there's one other way and that is they can put more equity into the business. So there's but the bottom line is they don't plan for that growth. And if you don't plan for that growth cash-wise, that growth is going to put you into bankruptcy because all growth costs money. Sometimes you have to expand your facilities, you have to hire more resources, you have to lease more equipment, you have to buy more inventory. Well, that inventory costs money. And that inventory is going to sit inside your facility for a period of time. How are you going to deal with that gap between what you need and what you have? And that gap is all called cash. So I focus on the cash element of every small business that we work on, because the small business doesn't focus on the cash. And we can squeeze cash out of that balance sheet by reducing the AR, by increasing the AP, and by reducing the amount of turns that inventory provides you with. So the more turns that I can have of that inventory, that means I'm buying less inventory, I have less cash tied up. That means I can in fact use that extra cash to invest and earn me more money.
All right, thank you, Neil. So there's these opening statements that give me a lot of questions that I have written down that I'd like to ask, but I'm biting my tongue at this point. All right, I'm coming over to you, Joe. What from your end, relationship management and basically one of the top guys at Bank of America down here.
Yeah, good morning, and thank you all. Neil, you took a lot of my thunder out of there. I want to say at first, every company experiences durations of negative cash flow. Call it payday. You pay out more than you receive in potentially on paydays, or when you pay a big inventory order or something like that. So managing that cash flow is what takes obviously the owners and or the decision makers of the company, because the shorter the duration of that, the easier it is to deal with. You can collect ARs quicker, you can hold off on APs, but overall, it's really important to understand what, and you were touching on it, Neil, what cash flow is not. It is not your revenue. It is not net income. It is not liquidity. It's not the ability even to pay bills. Net income And cash flow is a great indicator of cash flow. Liquidity gets you through that payday when you actually have a negative cash flow for that day, for that hour, for that minute. And just because you can pay today's bill doesn't mean, on Friday you can pay payroll. So when we're at the bank, we kind of look at, there's all kinds of different risks that we look at. The hardest one to quantify is the actual borrower's character and things like that. So let's put that aside right now. Let's just assume everybody has good enough character to go out and get a loan. Well, then you look at your collateral. Well, collateral can cause a lot of risk. We all learned that during the real estate bust. Real estate wasn't really as valuable as we all thought it was if you can't find somebody to buy it. You also get risk from your inventory. If you have a highly specialized inventory, it could go obsolete. Anybody that has anything to do with tech knows that just because it's worth a lot today, a new widget can be made tomorrow. So we try to balance all these things. And as long as it's not the character, we can mitigate it or structure a loan to meet that risk. And if it's that inventory, well, maybe we don't advance as much because you have a highly specialized inventory. But there is a number there that we can get to. It may not be what you want to see, may not be 80%, which is pretty much an industry standard. It may be 50%. But again, we look at all different types of risk. And I can just tell everybody, do what's right every time, because the character part of it is something you can never get away from. So if you have a temporary slowdown, we can manage through it. It's just, okay, do we increase a credit line? Do we restructure debt and things like that? But I'm going to keep it brief because I know you got a lot of questions.
That's fine. I'll come back to you. Sure.
Well, if you don't mind, I'd like to jump in here for a second.
Sure.
One of the things that small businesses have a real problem with, and it was just alluded to, is the difference between profit and cash. Profit is something that the company pays taxes on. Cash is something that they pay bills and take out for their own personal life. The difference is that the small business person doesn't understand, because they don't understand the balance sheet. And from the banker standpoint, I would believe that the balance sheet is more important than the income statement. So let's say I'm generating a profit of $100,000. I look at my bank account and there's only $25,000 in cash in there. Where's that $75,000? Well, did you take distributions from your S corp? Well, that's not on the income statement. That's on the balance sheet. Did you pay off some loans? That's not on the income statement. That's on the balance sheet. So you're using cash for other purposes than for necessarily the everyday operation of the business. The small business person really doesn't look at that balance sheet because they don't understand it, and they don't understand the value of that balance sheet. The other issue I'd like to bring up is, in today's COVID environment, we have a lot of money that's being left on the table. Yes, everybody's getting PPP money because that's the big thing right now is PPP. But there's a more important, in my view, a dollar bill sitting on the table of every small business that's going to expire at the end of the second quarter of this year. And that's the employee retention tax credit. The employee retention tax credit is a tax credit that you can take right off of your payroll reporting document called a 941, that you can keep 70% of what you took out of the employee's paycheck and their salary for the next 2 quarters. That's quarter 1, which you haven't filed yet, and quarter 2, which is coming up. 70 cents on every dollar you're allowed to keep. And your payroll company should be familiar with how to process that. The caveat to that whole thing is that you cannot use the the employee retention tax credit for the same payroll dollars that you're using to pay with PPP money. So you need to just keep some good bookkeeping records, because your PPP money only has to be used for 60%, has to be used 60% for payroll. So you got 40% of payroll that it doesn't have to be used for. Consequently, you can use that other 40% of payroll to be able to take the employee retention tax credit right off of your 941 for quarter one or quarter two. You keep the money. You don't have to wait for a refund from the IRS. You keep the money. You don't send it. That's a huge amount of money. If you think about 30 employees, and you can use up to $10,000 a quarter per employee and keep 70% of it. That's $7,000 that you can keep per employee and not have to send it to the IRS, that you could reinvest into your business and to reinvest into your business to help the business grow. So these are issues that we can help you with at the SBDC, and your CPA should be able to help you with these issues also, and your payroll company can help you define these things because they're the ones who fill out your 941 for you.
Perfect. Thank you, Neil. So again, anyone that hears this that likes to save money but didn't quite understand what someone was talking about, please just email us at the end. We'll connect you with the appropriate panelist. You can ask any questions you'd like. All right. So as a company, should I be building a credit behind the scenes if I normally operate on my own cash flow? Is it good to start establishing a relationship with a few local banks? Or Joe, what do you think about this? If I got cash in the bank, should I be, financing something at this point in time?
Well, again, if you look at it, if you want to read some books on cash and what's the best use of cash, the most expensive cash you're going to use is, believe it or not, going to be your own. Because if you leverage that cash instead of using all cash, you can perhaps grow your business faster, which is a much better return than just paying for $100,000 piece of equipment with cash. So it really depends on how you're looking at it. You should always try to keep, if you have a trusted bank advisor involved, because again, we just went through, we're going through COVID, and we got into all of our customers' financials really deep, and the ones that needed help, we figured out, okay, well, you just need to forecast this. So getting back to kind of what Neil was saying, there is a cash conversion cycle under normal operating where you spend money and then you end up getting it back at the end. Well, I mean, as long as you can understand that, and as long as you have a baseline of what you're going at, you can predict what will happen if your revenue goes down 30%. There's formulas for this. It's tough because you don't do it every day, but it's really basic. I mean, there's 8-10 inputs, and then you have your product. And again, that's actually more important for companies that are growing. Getting back to the original question, just because you increase revenue doesn't mean that you're increasing cash flow, doesn't mean you're increasing net income. It has to do with, again, Neil was talking about the operating cycle. There's all these different components that go in there. There's AP, there's AR, there's customer deposits, there's depreciation. You have to understand those things. And if you don't have the expertise, reach out. If your banker doesn't have the expertise, find a different banker. And then there's things that take money out of your company. If you pay all your payables, everybody knows that's the easiest way to get out of your money. And we're talking about if you can't meet your short-term liabilities, you're insolvent. I mean, you could everything could be for nothing. So you just got to focus on getting a good relationship with some trusted people internally. And everybody on this call, basically, I always say you got to be in touch with your insurance agent, because he and she could mitigate some of that risk. You got to have your CPA in there, because the wrong banker may tell you to do something that costs you $100,000 in taxes. Well, you need to know that when you're getting into the deal. But again, yes is the short answer to the question. You need to be planning for the future, good or bad. And then depending on which way you think it's going is how you react, and you take out credit lines for that growth. You can finance that growth if you know it's coming.
Yep.
So
I guess we'll go back to Neil. Neil, is it better right now to have long or short-term loans?
Well, the answer is every situation is different. First of all, if we're talking about working capital is the stuff that you use every day to make your money. That is accounts receivables, it's inventory, and accounts payables. It is not a good idea to finance working capital with long-term loans. If you have a working capital and you have short-term needs, it is good to match the needs with the debt. And I agree 100%. The cheapest capital that you can get is from the bank, because you can take your dollar and turn it into $3.50 in the investment that you make in your own business. So with the low interest rates that are out there today, for example, you can go out and buy a Lexus today for 0.9% interest. Why in the hell would you want to pay cash for a car? You say, from 0.9% interest. Over a 5-year period of time, that's less than $600 over a 5-year period of time. Now, if I took $48,000 out of my pocket to pay cash for a automobile, I'm starving my company from growing with that cash. So consequently, he's absolutely correct. It's the cheapest money out there is at the bank right now. So to answer your question, we try to match the longevity of the need with the longevity of the debt. So if you're buying equipment, certainly long-term. If you're getting it for working capital, I would suggest certainly short-term. The need has to be balanced with the length of the commitment.
That's a good answer. So it may sound like I'm jumping around a little bit, but since we have different experts in sort of different fields here, we may jump between, some CPA questions, some insurance questions, and some cash flow questions. So this one's going to go down to Donald. Donald, can you give us kind of an indication or give us some info on the 100% depreciation deduction? Is that still in effect, and how can we take advantage of that?
Yes. So, back a couple of years ago with the Tax Reform Act, President Trump signed in, and we were able to take 100% bonus depreciation on short-lived assets. So these are assets that have a life of under 20 years. So most importantly here for manufacturing companies, this is essentially everything in your business outside of the building itself. So your machinery, your equipment, everything used to run the business is eligible for 100% depreciation the year it's placed in service. And that includes not only new equipment, but used equipment, which previously was not allowed. So, and bonus depreciation set at 100% is set to start sunsetting here in a couple of years. So starting in 2022, it will decrease to 80% and then 60%, 40% down until 2025, which it's set to go away. Most likely, this has kind of been on and off again for the past 10 or 15 years. And it's probably likely to expire and may come back as like a 50% credit, which it's historically sat at. But so it's really important now, especially with how cheap it is to borrow cash, to keep investing in your business, install these new manufacturing lines, get new equipment. One, you get the benefit of using cheap capital, and two, we get that deduction up front, so you can lower your tax burden and also get a pretty good loan rate.
Okay. Now, do you always recommend depreciating that full amount in the first year, or is there some benefits potentially, linear depreciation?
Yeah. So typically, there's really no reason not to take full bonus depreciation in the first year. There may be situations if you're expecting ownership changes, especially like a significant change, you may want to defer some of that depreciation, waiting for a new old owner to go out that may not need that deduction, or to encourage new investors to come in future years to say that here there's depreciation available, instead of saying here you're buying fully depreciated assets that may not be of value to an investor.
Okay. And then I guess
you
go ahead, Neil.
You mentioned a linear depreciation. Depreciation on assets of less than let's say 7 years, which is most of the equipment, is not linear. Okay, it's front end loaded and back end loaded. So we don't just take 1/20th. For example, a 5-year asset, we don't just take 1/5 of it every year. So it's called a accelerated depreciation method. So I just wanted to clarify that it's not linear.
Thank you. All right, I'm going to swing back to Scott at this point. So if my business, doesn't require liability insurance for maybe projects I'm working on or specific products I'm making, how much liability insurance should I be taking out? How do I gauge, the size of my business to the insurance policy I have?
Sure. Well, really, for your small to mid-sized business, it's going to be pretty standard. Now, from our standpoint, whether you're making a widget, an air conditioner, you're making sunblock or dermatology products, all the different things we've had, airplane propellers. I mean, you name it. From a straight hazard insurance perspective, it's really pretty straightforward. When we come in and do our analysis and we sit down and we talk with you, the first thing we really need to understand is what is your product? What is your product and how is it used? Because when we insure your product, when it goes out into the marketplace, you have it insured. And we need to understand what it is and what are the exposures and what are the potential risks for that product. If I'm doing a dermatology product, is it going on the body or in the body? Is it an air conditioning unit? Is it commercial? Is it residential? What is your expected life of that unit? There's all kinds of different things. And what we will do is we'll take your particular product, bring it back, and we have resources to pull it up by SIC code, take a look at what some of your competitors or like businesses are doing, and we can take that and we can benchmark what they have versus what you're doing. And we do that based on the type of product and then based on the revenues. Most people have $1 million general liability, pretty straightforward. The amount of umbrella that they have will depend on the size of the business and what they're doing. I think Neil mentioned professional liability. If you are designing products, changing products, receiving a product, putting your own label on it, maybe adding or subtracting to it, you may need a professional liability policy. So it's really going to depend specifically on what you are doing and the analysis that we have about what you're doing, how you're doing it. And then more and more, are you selling in the United States or are you selling overseas? Do you travel overseas? Do your employees travel overseas? Do we need to take care of those folks that are out there? So the insurance, while the hazard insurance package, property liability, work comp, umbrella, auto, is pretty straightforward. It's really how it's customized to what you're doing. Not everybody needs a certain level of umbrella. Not everybody may need a hired and non-owned auto policy, professional liability. But I think it goes back to what's been said by a couple of the other presenters already. And I want to take it from just an insurance limit and go back. And Joe kind of talked to it as well. What you need is that when we're talking about insurance and all these other things about managing cash, is a trusted advisor. Trusted advisors are the people that are on this call right now. You need to have someone that you can trust to come into your business and talk to you about what do I need and what's in my best interests. And for your small, through my experience, your small and mid-sized manufacturers are internally focused on their product, on their employees, on what they're doing day to day. And they never get that chance or have a very limited chance to step back and maybe talk to a person like Neil about, okay, what strategically do I need to do? What's coming up in the future? What should I be thinking about? Because they said, if you just worried about $1 of cash today, and you're not worried about the cycle of that cash, you're really missing out. A lot of times people say, Scott, I'm a $2 million operation. Well, that's great until you have a negative cash flow. So sometimes you got to pull back and not work. And I say it all the time. Manufacturers are great for working in their business, and we are focused and dedicated to the size of the widget, the supply chain, the cash flow, the dates, how long we hold our cash and all that. Sometimes you need to step back, not just work in your business, but work on your business and use your trusted advisors to talk to you about what you're doing, what you should be doing, and make it a little bit broader than just saying, I think Neil said earlier, do I have insurance for my LLC? Well, yeah, I can get you an insurance policy. Does it cover all risks? No. Has it ever? No. Was it ever designed to cover COVID? No. Did we ever think of COVID before March of last year? No.
Yeah.
There's all these new and emerging risks that are coming along that should be talked about, and just be, and not maybe implemented, but just thought through with your trusted advisors, because they're the ones that have the expertise. A mid-sized manufacturer is so busy in his day-to-day operations, he may not think to call Don and talk about the newest legislative change for tax and write-off and loans. You cannot think of calling Neil for something manufacturing expertise or Joe on the cash flow cycle. But you need to have those people with the expertise on your team that can help you at all times.
Perfect. Thank you. All right. So, Joe, what are my options if someone's going over their allotted, you know, credit term? So they give them net 30, you know, they're at 65 days. What do I do at that point as a small business?
Okay, so you're talking about your AR is past due.
Mm-hmm.
Okay, again, there's very little you can do from a banking standpoint other than address the policy that allowed that person to get credit terms with you. And that's a lot of times when we're looking at lines of credit, which are short term, because they're short term assets and a short term loan. That's what we're looking at. We're looking for concentrations. If that customer is only 1% of your business, write the thing off and hope, but hope for the best and plan for the worst. If it's 80% of your receivables, that the problem of him not paying isn't the problem. The problem is you have a concentration of risk that you didn't either know or didn't understand. So most of my customers go back when COVID started and they kind of just reanalyzed everybody that they're extending credit to, because in this COVID scenario, there are benefactors. There are companies that are just killing it. And they're not the ones that you would think sometimes. Furniture stores, they're just doing awesome. Everybody's sitting at home looking at their old furniture saying, I'm going to go buy a new couch tomorrow. And then there's folks that are manufacturers. There's certain ones that are sitting there and like, oh my gosh, I'm making a little connector to a respirator. What a lucky day that was when that happened. But there's no real good way from a banking standpoint. But you need to plan. And once you get to 90 days, the bank starts taking those out of your available credit line. So if you have one that's 60, now is the time to address that person and do a formula of what is the probability. Going back to risks, there's a probability of payment, and then there's a loss given that default. So what are the chances of a customer not paying, and then balanced with if that customer does not pay? If it's AR, you can't get your inventory back. Maybe there's some repercussions to that, but it's probably 100% loss. So if you extend those terms, you better be sure on that probability of that person paying and not paying, because if they don't pay and they've already put your inventory into their product and sold their product, you have 100% loss every time. So you have to balance again, I think the probability of that customer not paying, and then with the assumption of, depending on what it is, that the loss given a default is 100%. Are you willing to take that risk? Because it may be better to be a $10 million company and make more money than to be a $12 million company and lose $1 million, because you tried to grow and it's like, well, there's nobody available. There's no good customers available. But that's how I would address that.
Joe brought up a good point, which I think needs re-emphasizing here, and that's the tax issue. If you write off a bad debt, everybody thinks that they can deduct that on their taxes, and that's not true. If you're a cash taxpayer, which many companies, small businesses are cash taxpayers, they haven't paid taxes on their accounts receivable. Therefore, they can't write off their bad debt. So the bad debt does not become a tax benefit. If they're an accrual taxpayer, then they have paid taxes on their accounts receivable, and therefore they can deduct their bad debt expense. I do a lot of tax returns myself. And the reality is that many service companies are cash-based taxpayers. Consequently, the bad debt that they have incurred is not a tax deduction for them, because they're paying taxes on only the cash that they receive and the cash that they pay out to their vendors. So it brings up a good tax issue that I thought needed to be emphasized here.
Yeah, very good point. Now, I think some small businesses also try to play bank, right? So instead of getting money down on a project, they may just extend their credit terms on a large project that might be too large for them at some point. Can you comment on that, Neil? How can you, I guess, hedge yourself against too much risk on your credit and your AR?
Well, the issue is that small businesses think from the top of the line instead of the bottom of the line. They look like they got a good opportunity to do a project for $40,000 hypothetically, and they don't understand the cost of that $40,000. Do they have the capacity even to do that $40,000 job without affecting their regular everyday projects that they're manufacturing? If they don't, then they have to increase their cost of operation, correct? Maybe they have to bring in more people, but maybe they have to temporarily bring in some extra equipment, and maybe they even have to go into another expansion of facility to do that 40K. They're not looking at that. They're looking at the fact that, hey, I got an extra 40K walking in the front door. Well, if you got an extra 40K walking in the front door, what's it going to cost you to get, and it's going to go out the back door, you say. So a good sharpening of the pencil, working with your CPA is critical. Working with your banker is critical, because all this, again, I emphasize, is the balance sheet. It's not the income statement. It's the balance sheet. And small businesses don't understand the balance sheet, because it's the balance sheet that provides the assets and the means to finance those assets. And that's where the banker and the CPA come in.
Thank you.
Can I cut in here too? So
Yep.
if you have that deal, call it the $40,000 deal, it walks in your front door, and you understand the duration of, giving up your cash to buy whatever you need for that deal, and how long it will take. So in that example, let's say that you somehow outlaid or financed $40,000. Well, let's use a calendar year. If your cash flow for a calendar year, and I'm not talking net income, I'm talking about cash flow after all the operating, all the financing, all the investing is $40,000, you basically taking all of your annual cash flow to do that one deal. And it may look good in March, but when you need the money in September, that's when you come about it. So you just have to look at the size of the deal towards the size of your company, look at how long that duration or the holding period, call it an investment. A lot of people can understand holding periods and stuff on stocks and things like that, but you just got to match those things up. If you don't have a clue on what your cash conversion cycle is, or how much cash you make in a quarter or a half a year, you have to be extremely careful with financing somebody.
Yeah, it's tough when that carrot's dangling right in front of you, but I understand your point. All right, so I guess I'm going to go to Donald on this one. Everything nowadays, while as we go online, it seems like everything's going away from, a direct purchase to something that's a service-based model, right? Are you seeing a lot of bloat on the P&L from these service-based models where, the leasing overall long-term costs more than the actual purchase?
Yeah, I mean, I guess maybe in my client base, I haven't seen this significantly, but it's definitely something kind of we're looking out for as this ever-changing world, and same thing with like blockchain management, all these different things coming into play that are just changing the way everyone operates across the board. So
yeah, I see it.
Someone else has a little more to add.
Yeah, in IT, I see it a good amount. In software you're purchasing, everything's moving to a subscription-based model. I'm just wondering if it gets anyone in the hole, because you end up long-term paying a higher duration, and then you're really locking in, a higher expense every month.
Yeah, I mean, so there's just, again, bringing in your CPA at the upfront side of it. And let's just make sure we're looking over these contracts and the value that we're purchasing. Instead of saying, here, we're purchasing for a one-time use versus, and now we're applying to the subscription. That may lock us in for a 5-year deal when maybe really the benefit we need only 2 years. And then at the end of that, that software is outdated, or we're not using that product anymore. So just a lot of risk there too.
So we mentioned, P&L and being able to read a P&L, and a lot of small businesses probably have trouble with that. What do you give to advice, or what do you give to your customers as advice, Donald? If they're, new to this, maybe they have a part-time bookkeeper, they're not really detailing all their expenses. What should, the owner, the CEO look at first? What would be your primary categories for expense cutting or keeping everything less bloated?
Yeah, so primarily when we look at financial statement reporting, I mean, kind of like Neil said, I mean, the more important side of this is the balance sheet. So we're going through every item on the balance sheet and making sure those amounts are properly reported. And by reporting those amounts properly, we can push back up into the income statement to say, okay, here, I mean, are these expenses we're taking appropriate? I mean, are we expensing equipment as we're buying it instead of capitalizing it? So we're overstating our deduction. I mean, ultimately, it turns back for tax reporting that we can take full depreciation on that in most cases. But they're same thing. Do we qualify to be a cash basis financial statement so we can report income and expenses as we receive the cash? Or are we a larger business that's required to use accrual basis? So we need to accrue for these upcoming expenses and help kind of forecast these bills and expenses as they're coming due.
Okay. And then how do you prevent creep, I guess, in benefits and items that are 401k and all that? You know, it's hard to see that as you, like we said, about payroll expenses.
Yeah, getting there. I mean, it's just really kind of help make sure we get involved early on. I mean, the worst you can kind of do is wait till the end of the year and then kind of all of a sudden say, oh, so we did all this, or this is how we're reporting this, and then we're going back and trying to recreate these, or I mean, unfortunately go back down a year and say, oh, here, no, we should have done it this way to avoid this creep, and just make sure that we're appropriately reporting throughout the year instead of kind of go back and trying to correct at the end of the year when maybe there's a different approach we could have taken.
True. And Neil, I'll kind of address the same question to you. It's kind of an HR question, but it borders on cash flow management. You know, you're a small business. You want to incentivize your employees. You want to give them consistent evaluations on a yearly basis. I think there's some fear from the small business community that if you do evaluations, it always leads to wage increases. Do you get stuck if you're not doing them, and then you get people that are banging at your door all the time and disgruntled employees? Is it better to be proactive and do assessments even though maybe they're not always tied to a monetary increase? What would be your recommendation there?
Well, I think that that's a lot of stuff in one question. So let's dissect it for a second, okay? I think it's important that every organization set up KPIs, okay? And I think that there's a base salary that everybody needs to get based upon their qualifications. And I think that the increases and the bonuses need to be measured. There has to be a metric that measures everything. And those are the KPIs. Most small businesses do not use KPIs because they really don't understand how to. And that's where the CPA can help them. That's where their financial advisor can help them. Their banker, Joe over there, can help them. Once the employee understands the rules of the game, the employee will play the game. But if they don't understand the rules of the game, how can they expect to play the game? And then when they don't get a raise, they say, why didn't I get a raise? Well, because this, and this didn't happen. Well, you didn't set the rules of the game up front for me, you say. The other issue that we have is those KPIs have to be realistic to the specific job specifications that person is doing, you say. And they can't just be KPIs based upon the profitability of the company. You can do in today's technology world a consumer satisfaction immedially after you talk to a customer on the telephone or on the internet. Okay, you can get a feedback. There's auto systems that can give that to you. It really upsets me to see when I do business with a vendor and they don't come back for a consumer evaluation survey with me. No, but not even the salesperson who's getting a commission off what I'm buying. They don't come back with it. They obviously don't understand what KPI is all about, you say. Going back to the retirement issue. Many small businesses don't have retirement plans or benefits or insurance for their employees. They tell their employee to go to the marketplace. Okay, well, the marketplace is fairly expensive in today's market. The marketplace is where the government subsidizes your premium based upon what you expect to make that year. Expect is the key operative there, okay? At the end of the year, you do your tax return and Doug does your tax return, then all of a sudden you made more money than what you told the marketplace that you made. And now you're going to have to pay back some of that subsidy. And instead of getting a refund, you're going to owe taxes to the government. Okay. Health insurance is very expensive. We're recommending, and I'm sure that, or I'm recommending that people look at a HSA plan because it's a high deductible, lower premium. There's a lot of variations that you can do to make it more affordable for a business to offer this. The other issue, let's talk about retirement plans. Okay. To keep good people, you have to sometimes provide some type of a retirement plan. For small business, there's a couple good ones. One's called a simple, SIMPLE, in which the employer is required to match 100% of the employee's contribution up to 3% of their salary. The other is called a SEP, SEP, and that has no contribution by the employee, but 100% contribution by the employer. And it has to be a percent of everybody's income. So if I'm going to take 25% for myself, I got to give every employee 25%. Here's the issue with all those benefits. Employers who are small business people know that they need to provide something to their employees, but they don't have the cash to do it. That's the problem. Say, well, if you don't have the cash to do it and you provide it, then you better go over to see Joe over there. Because if you can't run your business effectively and efficiently with the right personnel and the human resources, by the way, which is not on your balance sheet, because human resource people are not on your balance sheet, you see. If you can't do that properly, you better go over and see Joe and figure out how you can do that and where can you squeeze the funds out of that balance sheet. Again, I focus on the balance sheet because the balance sheet's tying up your inventory and your accounts receivables. So where can you squeeze the cash out of that to be able to afford to keep good people? So I kind of broke that up into two separate sections.
That's fine. No biggie. All right, I'm going to move back towards the insurance side. We're mitigating risks. So Scott, you can have an insurance premium, or you can have an insurance policy that covers you up to $1 million. We're in the, I guess you can call it the hurricane belt. If you get hit by a hurricane, it takes down your operations. You're kind of out of luck until that money comes in and you can get back on your feet. Are there additional outside recommendations you give your customers in terms of having some type of a disaster rebuild plan on top of the premium?
Sure. Well, and not on top of the premium, but in addition to the premium, and we can pay a premium. When we talk about insurance, not everything's insurable. There's insurable risks and there's uninsurable risks. Now, a hurricane that impacts your business is going to be an insurable risk. What we would have in place if the hurricane came and it damaged physical property, we would have the business income coverage. And while I'm here, and in light of COVID, a lot of people, and there's still a lot of lawsuits out there about people wanting to sue their insurance company for a lack of COVID coverage. COVID as a coverage was never intended, if you want to call it a quote, a healthcare hurricane, it was never intended to be covered under any insurance policy. It's a health insurance policy. And for us, it's really a health insurance issue. It didn't affect your plant, it did a physical operation, and it did not cause any damage to any of your real or personal property. So when we have a hurricane, we have damage to real and personal property. You need to take a look at your business income limit of insurance that's on your property policy. Business income, the net income from operations and extra expense can be covered by an insurance policy, not just from a hurricane, but from a fire, from lightning, from any other source of that's coverable under that policy. But the trigger for business income is you need to have damage to your physical property. That is the first key that puts that business income coverage in. And we have had claims. Business income coverage is one of the most misunderstood coverages that we had. It's complicated. It's really more accounting and balance sheet and income statement driven and extra expense driven than it is anything else. But what we have to do is make a business income calculation. And most people, since I'm on the expense side of the business, will underestimate the amount of time that they're going to be out. If you'd asked me last year, I'd be sitting at home for a year because of COVID. We'd all said, Scott, you need to be put away for a long time. That's never going to happen. Well, think about if we're going to strategically plan, if a hurricane hit me in Southwest Florida and took down my manufacturing operation, where would I go? What would I do? How long can I really get back? And am I going to get the same people back? Or they need to go find jobs anywhere else? So business income can cover the business income, the net loss of that business. It can cover your payroll, depending on how you structure it. It can also cover the extra expenses, bringing in expertise, bringing in advertising, bringing in a Scotsman's trailer to put my headquarters in, putting the phone lines to that, bringing in a specialty manufacturer expert that or equipment. All those things can be insured, whatever it takes to make that net loss and that time out of operation smaller. And I would tell you one thing: when you ever get into a business income claim and it's serious and complicated, you have to have a CPA with you or a financial professional with you that entire step of the way. A lot of the terms in an insurance policy are not defined. They're pretty broad, but every additional expense, every dime that you're paying, every invoice needs to be looked at for determination, is it coverable or not. It's very important. Most people underestimate the time that they're going to be out because we've never experienced it. And also think about where in your supply chain. Do you have people in Louisiana, Mississippi, and Texas? If you have an operation that you depend on in the Panhandle and it's in Destin and it's a mile from the coast, it's just as much at risk as you are. So if I lose that component, if I lose that software, if I lose that cloud computing operation, if I lose the guy that's making my most important widget, what happens if he goes down? What happens if he has a fire? And you see when these businesses close because there's been an explosion or a fuel plant. You see it on the news all the time. Well, what if I'm across the street from them and I've got to shut down for a week? What is the risk to my business? So to answer your question, we do have business income for hurricane. It needs to be customized to what you do. We have set worksheets that we go through, talk about the time out of business and all of that, but also think on a little bit of a bigger picture. What other important elements to my product should I be thinking about? And what is the risk if one of them is unable to operate in the future as well?
Just to give you an example, I have a client that services other businesses, and one of the businesses got infected by cyber attacks. Without cyber insurance, it would have cost my client $70,000 to bring in a specialist out of California to recapture that data that manufacturer lost. We're not talking nickels and dimes, we're talking huge. But because my client had the foresight to buy cyber insurance, that cyber insurance paid that $70,000 to satisfy the needs of his client to recover their data so that they can continue to service their customers.
Perfect. Thank you, Neil. Joe, what's the current status since we're going through potentially the second round of PPP loans? Has anything changed? What should they be aware of? Lessons from the first round. Can you give us any insight into that?
Well, the only real change is obviously you have to show that you had a decrease in any quarter last year compared to 2019. I believe it's 25. And they decreased from 500 employees, the maximum number of employees, to I think it's 300 now. But having lived through it now, it's actually coming to an end. It ends at the end of this month. I was very happy to see that of the 20 customers that got it in 2020, I had 3 or 4 that even applied for it this year. Now, the funding is much quicker. It seems that the SBA has learned some stuff. Banks have learned some things in there too. But the biggest changes to the program have to do with who is eligible. And there's that decrease in revenue, any quarter, 25%, and then the decrease in total number of employees. Now, Biden had put some changes in there that put everybody above 20 employees on hold, but that's all expired by now. So It's virtually the same with a couple different caveats in there. And most companies, quite honestly, that I deal with could not prove that they were down 25%. Quite to the contrary, some people really had good years last year.
There is a big change for sole proprietors, though. And this just came down recently in the last 2 weeks, that in the past, sole proprietors who don't have any employees, but just operate themselves, had to take their net profit, and they had to take 1/12 of it and multiply it by 2.5, and that's how much money they could borrow and get forgiven. Today, as of a couple of weeks ago, they can take their revenue, not their profit, but their revenue, which is a huge number compared to their profit. And they can take 1/12 of that revenue and multiply that by 2.5. That could be the difference between $10,000, $20,000 that you can borrow versus their profit. Think about your revenue of 100K, okay? Whereas your profit's only 10K. Well, 10K in the past, you would have had to take 10K divided by 12 and multiply by 2.5. Now they can take 100K, maximum of 100K, that's the maximum, and they can divide that by 12 and multiply by 2.5 and get that money, and it's automatically forgiven because they're sole proprietors with no employees. It's called a replenishment compensation for self-employed. So that's a huge, huge difference in the calculation of the formula for sole proprietors.
Thanks, Neil. Again, if you didn't follow that or you couldn't follow the math on that one, just email us. We'll connect you with Neil, or we'll try to answer the best we can. Donald, for you, how can I ensure my accountant or my, whoever's doing my taxes is taking advantage of any business credits that are available out there right now?
Yeah, so I guess the big ones, especially this year, we've been looking out for as overseen credits. Neil mentioned earlier the employee retention tax credit, which is a huge credit. Even in 2020, it's a credit for wages paid after March 13th of 2020 through the end of the year for qualified employees, either once they had a permanent or a full or potential or partial shutdown for a set period, wages paid during that period, or if they had a significant decline in gross receipts as 50% of a quarter reduction 2020 compared to 2019. And that credit extends quarterly after that until they restore to over 80% of 2019's quarterly income. For 2020, it's a $5,000 credit based on $10,000 of wages per employee for the year. 2021, they've expanded that very generously. Neil explained this earlier, where it's $7,000 credit based on $10,000 of wages per employee per quarter. And actually, with the American Recovery Act just passed last week, this is actually extended all the way through December of this year. So we eligible for 4 quarters. So potential of $28,000 in credits per employee if you have these qualified periods of shutdown. Again, as Neil mentioned, if you did receive PPP loans, you cannot use the wages for both the qualified for forgiveness and the credit. But with 2020, as we're kind of retroactively doing this now, is we're allowed to take the most beneficial way of once we file the PPP loan to say, what's the minimum amount of wages that we can use to qualify for the PPP forgiveness, and then also take the rest as eligible employee retention credit wages. So I mean, that's really the big one we're focusing on now. Some of the other ones that are just commonly missed are workers' opportunity tax credit, which is a credit for hiring certain targeted employees. So when I think of which employees qualify, especially for manufacturing groups, certain veterans, ex-felons, summer youth employees, so 16 and 17-year-olds you're employing between May 1st and September 15th only. I mean, it's eligible for a small credit. And also, and kind of bigger this year, is these long-term unemployment recipients. So people have been on unemployment for over 27 weeks that are now coming back into the workforce, which is a lot more common now with kind of COVID, that people have been out of work for quite a while now. I mean, once you bring them back in, we can potentially get a credit of somewhere between 25 and 40% of the wages, depending on how long they're employed for the year. Kind of the one caveat to this one is within the first month of hiring them, there's a certification we have to file to make sure that they actually qualify as a targeted class of persons. So it's an easy one to kind of catch that maybe you wouldn't qualify in a normal year, but maybe this year is a little different with everyone coming back to the workforce.
Take a look.
Research and development is always a big one. So if we're changing or modifying the way we do things, we're looking into improving our product or the way we produce our product, become more efficient. This qualifies for a small credit. So it's just additional money we can get back for doing those things that help grow our business anyways. And then the last one is just looking out for state and local incentives for perhaps if we're building a new facility or we're looking to relocate. I mean, a lot of states and cities are really fighting over bringing on these new manufacturers to bring in new workforce and employ their community. So, and when you're in the process of considering moving, just making sure you're reaching out to your CPA group to make sure that we can reach out and start communicating with cities and saying, you saw it with Google or Facebook, when they go to relocate, they get these huge tax incentives. I mean, there's also ones for much smaller clients. So, I mean, you may not think that you're not as important to the city as they are, but you still are, because them saying, hey, maybe we have 50 new jobs coming into our city is very big for them to grow their revenue.
Perfect.
Jeff, I think it's also important that the business out there that's watching this to understand the difference between a tax credit and a tax deduction. Quite different. The tax credit means that they get a dollar for dollar refund from the government. A tax deduction just means that they save only the dollars of which the tax bracket that they're in. So if you're in a 20% tax bracket and you save $10, you're only really getting back $2. The reality is, if it was a tax credit for $10, you would get $10 back from the government, you see. So there's a big difference in tax credits, as Donald already mentioned, is all the money sitting on the table of all these manufacturers because they're not aware of it, and that's why they need to contact their CPA to take that money off the table and put it into their pockets. It's extremely important. The other thing that I might mention is that we're doing a lot of individual taxes, and every person out there is that's an S corp is also throwing their profits into their personal tax return. If they're a partnership, they're also throwing their taxes of the partnership into their personal tax return. So if you've collected unemployment, the government just said last week that the first $10,200 of unemployment compensation is not going to be taxable. The problem that you have today is this tax software doesn't recognize that yet. Okay, so if you go out there and do your personal return and you had unemployment compensation, it's going to be taxed. So the reality is you need to wait. The IRS sent out a notice yesterday saying you might want to wait to do your taxes until we figure out how to get all these tax softwares updated so that you don't have to do an amended return. Because that 10,000, I did one yesterday, and I calculated the difference between including their unemployment and not including their unemployment. And their unemployment was about $9,000, which was part of this whole deal. If you included their unemployment, they got a $300 refund. If you didn't include their unemployment, they got a $1,200 refund. So it makes a big difference when you look at the dollar bills. So again, your CPA can help you with all these things. And the dollar that your CPA charges you is going to be given back to you in all the benefits that they provide you with.
Great point, Neil.
I'll bring up one point, Jeff.
Yep.
Yeah, I think one of the things that strikes me as we go through everybody here is not just, we talk about cash management, financial risk. But really, if you think about all we just heard, how do we manage the information that we're getting? There's so much coming out about all the PPP, QQQ. This, I can't follow it. But from a small business perspective, as that owner, you really should be reaching out to your professionals, your trusted advisors. Hey, this is what I'm thinking. This is what I heard. Because Don may get something today. Neil may find it in his professional networking next week. I know Joe may hear about it from a banking perspective. In the insurance business, we're going to be last to get the information. That's just the way it is. But there's so much information coming out there so fast. You really have to reach out and just talk to people. Say, this is what I'm doing. These are the challenges that I'm facing. What can I do? How can you help? Have you heard about anything? It's going to be tough for all of us as professionals to instantly reach all of our clients. But if you have a need today and you have a question, you really should be reaching out and just having a conversation. Maybe it's just a lunch, maybe it's just a beer, and just talking about where am I going to get all this? Because the information management now, of all the things that are out there, there's no one person that can be an expert in all of them. It's just not. And that's why you should have that board of trusted advisors to talk to you and to be there for you when you need them.
That's a great point, Scott. And that's kind of where the SRMA would, likes to sit themselves, as being that conduit between experts in our industry, local, regionally, and the business owner. So if you have questions, you want us to, connect you with any of these guys or anyone from our previous roundtables, we try to develop the network to support any small businesses here. And also comment on Neil and the SBDC. Basically, they have free services that will help evaluate your business. I've used the SBDC before. Great resource to basically point you in the right direction and give you advice on who to contact and how to get in touch with everyone. Great point, Scott. Appreciate that. This one will go out to, let's see, where'd I go here? I think this one was this is for Neil. Neil, can you give us a little bit, we're back to cash flow, a little bit of an explanation on cash to cash cycles? You mentioned, I think, in your opening, maybe just elaborate a little bit better on how you time some of those, because that's very important, I think, to the.
So this is for a whole course, okay?
What's the cliff notes? Yeah.
It's called a cash conversion cycle, okay? So the cash conversion cycle starts out when you buy your inventory. If your inventory in a manufacturing environment is your raw materials, okay? So it starts when you buy your inventory and it ends when you get paid. And so what happens is you take how many days your inventory is sitting in your facility, in your warehouse. That's number one. The formula, if they want to contact me behind the scenes, I'll do the calculation for them. But that's the first thing. You look at your inventory, you see how long it's sitting. So if it's sitting there 45 days, you calculate the cost per day of your inventory and multiply that by 45. That's how much cash is sitting in your inventory. You then take your accounts receivable and do the same thing. How much money is sitting in my accounts receivable on the average over a period of time? And consequently, you come out with a daily accounts receivable, multiply that by the number of days, and now you have another, you add that to the inventory amount, okay? Then you go back to your accounts payable and you say, hey, how long can I stretch my payables? Because I'm not paying for my inventory right away. So let's say it's 30 days. So now we have two numbers to add together of how long my cash is being tied up. We subtract the payable amount because your cash isn't tied up for that 30-day period of time. And we have the number of days that we have to finance that particular operation. That's called the cycle, okay? Now, when you come up with that number, okay, which is not difficult to come up with, then you know how many dollar bills you need to go to Joe over there, and you need to be able to finance that on a short-term basis. If you don't finance it through Joe, then you're going to have to finance it yourself because it's increasing your assets on your balance sheet, and therefore it's got to be paid for if it's an increase in asset, either through your cash that you have or through retained earnings, but better yet, go to Joe and get a short-term operating capital. That's called the cash conversion cycle, which needs to be evaluated on a regular basis. Once that cycle's over, and let's say it's a 90-day cycle, you now have your profit in your pocket, okay? So let's say you're making 5% profit. Now you got that 5% sitting in your pocket to go through the next cycle. Because if you're a 90-day cycle, that cycle is going 4 times a year, right? So 4 times a year, I'm putting that 5% in my pocket or reinvesting it. So I can grow with that 5% if I want to. And that 5% that you're growing with is cumulative. So consequently, you can grow at a faster rate. The shorter you can make that cycle, if I can make that cycle 45 days instead of 90 days, I can turn that profit twice as many days and twice as many times, and therefore have more cash in my pocket. That's a summary of the whole course of the cash conversion cycle and how it works.
Perfect. Thank you, Neil. And just to tag on to that, we only have a few minutes left here, but how about timing capital expense purchases, Neil, with your cash flows? You know, if you get a large order, should you be trying to do, are you waiting for a large order to come in to make your, your purchase on credit? Are you doing it once the money hits the bank? What do you have for recommendations there?
Well, the first thing I would do is to find out what that large order is costing me in cash. Okay, and not get all excited that I got $100,000 order in here. Well, maybe it's costing you $120,000 to do that $100,000 order, and maybe it's also taking away your regular revenue and your regular profit. So you need to figure all that in, and that's called opportunity cost in the accounting environment. So what's the opportunity cost of that 100K order? Say, then you sit down with your CPA and your banker, and you say, okay, I got this big order. Can I get a line of credit to cover it? So give me a 90-day line of credit. I'll be able to get this order. I'll make a decent amount of cash, and the amount of money I'm going to pay Joe over there is going to be minimal compared to the amount of money I'm going to make on the order.
Perfect. All right, I think that wraps up. I have probably 30 more questions, but I don't think we have time for that today. So I want to thank everyone for coming out, all the guest speakers, Scott, Joe, Neil, Donald, appreciate the time. We really help bring some resources to this area. Again, thank you guys, Construction and McGriff Insurance. We appreciate you both sponsoring this. It's very helpful. We're trying to build a network here and an association that's worth its weight. So again, if anyone would like to support the Manufacturing Society down here or the industry as a whole in Southwest Florida, you can sponsor or you can become a member of the SRMA or the Southwest Regional Manufacturing Association. We're a nonprofit. That money goes directly towards helping out small businesses, helping out firms for manufacturing in the area, providing resources and doing these types of networking events. If you have questions for any of the panelists or any SRMA members in general, you can email us at info@srma.net. On our website at srma.net, you can find upcoming events. You can sign up for the organization there as well too, and get an idea what we're into. So again, I appreciate everyone out for coming out today. Panelists, thank you very much for your time. Hope I didn't stump you or get you too far. Thanks again, and have a good day, everyone.
Thank you.
Appreciate it.
Thank you.